Hello, everyone. Welcome to Deloitte's Debrief Tax webcast series in Asia Pacific. Our webcast today is on our Geographic Update series, and it's titled Enactment of Macao's New Tax Code, Transfer Pricing and Other New Tax Rule. My name is Kayan. I'm a tax partner of Deloitte China covering Macao tax. I have the pleasure of hosting today's webcast. With me, I have another speaker today, Flora Zhang. Flora is a transfer pricing director of Deloitte China, and she also covers Macao tax. You may have access to our bios on the left side of the screen. Before I introduce the agenda for today's webcast, I'd like to take a moment to highlight some of the features of our webcast console. First of all users are on listen-only mode. If you have any content-related question, you can submit at any time in the Q&A box at the bottom right of the screen. We'll do our best to respond to your questions during our presentation or at the end of our session. Secondly, all PC users can maximize or minimize each box at your convenience during the webcast. You may also explore the icons at the bottom of the screen. If you want to download today's slides and related publications, please go to the Download and Links box. On the other hand, mobile device users can view the slides and answer the survey on screen. Thirdly, if you require an attendance record for this event, you will receive an automated email with CPD certificate after watching for 50 minutes. Now, without further ado, I will now go through our overview of the topic with you today. So today, Flora will first go through the transfer pricing rule newly introduced into Macao Tax Code, which will take effect from the 1st of January 2026. In the second part, I will go through with you other new tax rules also codified into the Macao Tax Code in recent months and will take effect partly this year and partly next year. At the end of our two sessions, if time allows, we'll also have a Q&A session to answer some of your questions posed on Q&A box. So without further ado, I'll now pass the time to Flora. Flora, over to you.
Thank you, Gaia. Thank you, Gaia. Welcome, everyone. Thanks so much for joining today. My name, as introduced, my name is Flora, and I'm the Transfer Pricing Director of Deloitte Hong Kong. Today, I'm very happy to have an opportunity to share with you all the on the new launch transfer pricing regime in Macao. In fact, transfer pricing is quite a new concept to the Macao tax system. Before the passage of the TP laws in Macao, the Macao tax registration also provides very limited guidance on transfer pricing and how transfer pricing would apply in Macao's corporate tax daily context. Before we go into the details of the TP regulation, perhaps we can have a quick recap of some of the critical milestones in relation to the TP in Macao. Sorry, the previous slide. The one before. Can you show the roadmap of the report? As the previous time. Thank you. Oh, thanks. Yes, here is the roadmap of the transfer pricing. The concept of the concept came into Macao Tax Authority site is in November 2016 when Macao first joined the BEPS framework, which also known as the Inclusive Framework on Base Erosion and Profit Shifting released by the OECD. Being an associate member of this framework, Macao has committed to implement the BEPS 4 Minimum Standard Action Plan, including action plan guidance on country-by-country reporting and mutual agreement procedure, which we usually call it MAP. In January 2020, the Macao Financial Service Bureau, FSB, released the Administrative Regulation, which focused on the multiple enterprise business activity records, as well as the law which provides the regulation on the comprehensive test. This regulation set out CBCR requirement for the groups with a Macao UPE and have revenue exceeding 7 billion pataka. At the same time, they provide MAP arrangement in the existing 7 treaty between Macao and other tax jurisdictions. After all this effort, the Macao government passed the new tax registration in December 2024, and they will come into force on January 2026, as Guyan introduced. In today's session, while the detail of the new registration are yet to release, I'll introduce and share the topic with reference to the regulation and practical experience from both mainland China and Hong Kong. Next slide, please. So here is the agenda of our webinar. We will cover the transfer pricing environment, the transfer pricing documentation, and the definition of the new registration, and also the transfer pricing arrangement, transfer pricing method, and also Guyan will cover the part of PE and other tax part. Okay, next page, please. To begin with, what is transfer pricing? Next page, please. Transfer pricing refers to the price of a transaction between the related parties. However, you may wonder why transfer price is so important when it's only an internal price we sell to a group entity but not to an external customer. In fact, by adjusting the transfer pricing, a group can allocate its profit to different jurisdictions in order to minimize the tax burden of the group as a whole. Let's look at a simple example, and perhaps you can have a better picture on how transfer price works. The example says like this. The PRC company purchases products from a related party supplier at 100 and sells it to subsidiary in Macau. The Macau company and them sell to the market at 200. The selling price from the PRC company to the Macau company will be the transfer price we are looking at. For the case 1, the PRC company sells to Macau at 120 and earns a profit of 20. As the tax rate in the PRC is 25%, the PRC company will have to pay enterprise income tax of 5. On the other hand, Macau company will earn 80 and pay 9.6 tax as corporate tax rate in Macau is 12. If we add up the tax amount, the group will have to pay 14.6 of a total of the tax in total. So how about if we change the transfer price? In the case 2, the PRC company sell to Macau company at 180 instead. The tax burden of the group as a whole will increase to 22.4. From this simple example, we can see that MME Group can control its tax cost by adjusting the transfer price of its related party arrangement. This is also the major reason why tax jurisdictions around the world become more aware of TP. Next page, please. In the Macau tax law, the transfer pricing refers to the transfer price of commercial or financial transaction made between Macau taxpayer and related parties in other tax jurisdictions. In other words, only transactions between Macau taxpayer and overseas related party are in scope. A transaction between related parties in Macau will not subject to TP rules, even there is actual tax difference between these entities. This differs from the PRC and Hong Kong TP rules, which no actual tax difference in order to be exempt from the arm's length requirement. Transaction between Macau taxpayer and related parties in other tax jurisdictions has to be conducted in with the arm's length principle, meaning that the transaction should be conducted under the terms and conditions that would typically be agreed upon between the unrelated parties in comparable transaction. However, how should we define comparable here? Does it mean that we sell to the related party at 200 when we sell it to the third party at the same 200? In fact, this is not necessary in the case. The reason is that apart from the selling price to the market and the condition and the terms of the transaction will also lead a difference in selling price. In order to ascertain whether the transactions are comparable, we will need to apply different transfer pricing methods to analyze the transactions. We will take a little bit more time on the TP methods at the later part of the session. Next page, please. Another question you may have in mind could be how a related party is defined. Next page, please. The new registration in Macau defines 3 types of related party relationships: direct or indirect control in the leadership, control, capital contribution, or voting right. Control by the same third party directly or indirectly. One party directly or indirectly influence the other parties. Let's look at the following 2 examples. In the first one, in the left one, the PRC company holds a Macau subsidiary through a Hong Kong company. So the Hong Kong company is directly controlled by the PRC company, while the Macau company is in direct control by the PRC company. All 3 are related parties. In the second example, in the right-hand side example, the PRC company holds both the Hong Kong and Macau companies, meaning that the Hong Kong and Macau company are controlled by the same PRC entity. Therefore, the Macau, Hong Kong, and PRC companies are all related parties. However, the Macau law does not specify the percentage of the ownership or controlling or voting rights required to be considered a related party. For instance, in the PRC, direct or indirect ownership of more than 25% of the share will be deemed as a related party. Where in Hong Kong, ownership more than 50% will be considered as related party. When the shareholding is between 26 to 49, it may lead to a situation that there is considered a related party in the PRC, but not in Hong Kong. It's worth looking forward to the percentage that Macau will use to determine related parties. Next page, please. Coming to the next important topic, how should we determine whether a transfer pricing is reasonable or not? To answer this, we need to analyze the transaction, use a suitable test method. The new registration in Macau provides 5 TP methods that are commonly used, and these 5 methods can be categorized into 2 types. The traditional transaction method include the comparable uncontrolled price method, resale price method, cost plus method, whereas the transactional profit methods include the profit split method, transactional net margin method, we call it TNMM. The new law also provides that other methods are also acceptable when these 5 methods fail to provide a reliable analysis. As the new law does not provide further explanation of this method, we will keep our discussion high level today and will not go deep into the application of each method. However, these methods are also generally consistent with those provided in the OECD guideline, PRC, and Hong Kong TP regulations. Next page, please. In addition to the introduction of the TP methods, the new registration also provides guidance on TP adjustments. Next page, please. In Macau, TP adjustment can be divided into two scenarios. The first one is when the Macau authority takes an initiative to adjust a Macau taxpayer. If the Macau taxpayer and its related party fail to comply with the arm's length principle, the Macau authority is empowered to make adjustment to the Macau taxpayer. The second scenario is when the transaction between Macau taxpayer and related party are investigated and adjusted by the overseas tax authority. In this case, the Macau authority can make corresponding adjustment through mutual agreement procedure (MAP) based on the double taxation agreement (DTA). The condition for a corresponding adjustment is that there must be a DTA, a double tax agreement between the Macau and the overseas jurisdiction. Currently, Macau has signed DTA with only 7 jurisdictions, including Cambodia, mainland China, Hong Kong, and others. Therefore, if a transfer pricing adjustment occurs in region outside this jurisdiction, double taxation may occur. Next page, please. The Macau Tax Code also says that when the Macau authority makes adjustment to a taxpayer, the authority needs to provide the reasons. For instance, related party relationship, what transactions are being adjusted, what the situation would be under the normal transaction with unrelated parties, what method is used to determine the adjustment, and the final result of the adjustment. Article 116 of the law describes the conditions of implementing indirect assessment. For instance, when a taxpayer is unable to determine its tax basis, or when a taxpayer's return is lower than that of its industry without the reasonable explanation, when return, investment, and costs does not match. If we look at some general practice in PRC, the investigation in the mainland are divided into formal case filing and self-adjustment in general. In a formal case filing, all communication and final assessment have to be approved by the State Taxation Administration (STA) 国家税务总局 at the highest level. The investigation and adjustment can also roll back up to 10 years. This type of TP adjustment case is usually more time-consuming, as it sometimes will take up to 2 to 3 years to close. Also, the tax amount involved for these cases is usually larger. For instance, some big cases may involve more than 1 billion RMB. However, in case of double taxation, taxpayer can apply for a tax refund from the counterparty's tax authority through MAP. On the other hand, self-adjustment is more casual. The tax bureau in charge will require the taxpayer to conduct a self-check on its TP arrangement, develop its own plan, and calculate the additional tax needed. Although this type of adjustment is less time-consuming and the tax amount involved is relatively smaller, it is unlikely that the counterparty of the taxpayer to obtain relief or refund from the tax authority in case of double taxation, as is only a self-adjustment. On the other hand, from the Hong Kong practice, TP adjustments usually initiated by the Inland Revenue Department (IRD). This is the 7 years since the introduction of Hong Kong TP regulation. We observed that the IRD has increased the frequency of transfer pricing inquiry. In terms of TP audit, IRD can go back to the prior 6 years and initiate audit or adjustment. However, currently, the period of adjustment in Macau is not confirmed. For the criteria of adjustment, the PRC authority usually adjust to no less than the median point, while for Hong Kong, the IRD generally will make adjustment to the median. For Macau, such adjustment criteria are still pending to be confirmed. Next page, please. From the example, we can from the below from the example, we can see the impact of the transfer pricing arrangement on double taxation. The fact pattern is the same as the example we used to illustrate the transfer price, where the PRC company sells to the Macau subsidiary at 120. If the PRC authority step in and challenge that the profit of the PRC company is too low and adjust it to the selling price to 180, the PRC company will then need to pay additional tax of 15. That is 60 at 25% tax rate. However, on the other hand, this 60 of profit has already been taxed in Macau. Under this case, the Macau company can apply a corresponding adjustment to the Macau Financial Service Bureau, which is to reduce the tax corresponding to the 60 profit. For instance, if the Macau FSB agrees with the TP adjustment initiated by the PRC tax authority, the maximum tax refund in Macau would be 60 at 12%, 7.2. In practice, some tax authority can only refund according to the lower end of a profit range. For example, if the PRC tax authority imposed tax adjustment based on the median point, say 5%, but the counterparty tax authority can only refund up to the tax amount calculated based on the lower quarter of the profit range, say 3%, and then the 2% of the difference will be double taxed. Therefore, that is why taxpayers are suggested to plan their transfer pricing arrangement ahead in order to avoid the double taxation. Next page, please. Apart from what we have discussed, one of the impact brought by this new registration to Macau taxpayer is the compliance requirement. Next page, please. The Macau FSB requires taxpayer to prepare TP key documentation within 9 months after the relevant accounting period year end and keep this documentation for no less than 7 years. However, this new registration does not specify what TP key documentation is, whether it will be similar to that suggested in the OECD guideline, or the previous registration rolled out in 2020, that the groups with Macau UP and have revenue exceeding 7 billion pataka and have to prepare the country-by-country report, master file, and local file. Whether all taxpayers are subject to prepare documentation or may have any exemptions. At the same time, there are also many uncertainties concerning what should be covered in the documentation. We will need to wait for the supplementary law for the details. Besides the TP documentation, the new registration also hints the requirement of the related party transaction disclosure. The Macau FSB is going to revise the tax return. Starting from 2027, Macau taxpayers are required to report their related party transaction detail when filing their tax return. For instance, taxpayer has to disclose the name of the related party, a correspondent tax jurisdiction, tax identification number, a type of related party transaction, and tax transaction amount, etc. At this point, you may have a question in mind. What should I disclose every single related party transaction in the form, even the amount is very small, say 100 pataka. Is there any threshold on the transaction amount to follow? In any way, this indeed will increase the compliance burden of the Macao taxpayer. On the other hand, the related party may be reluctant to provide such relevant information. If a taxpayer in Macau fails to submit or keep the TP documentation, may result in a fine ranging from 10,000 pataka to 100,000 pataka. If this is intentional, and the fine will be increased to 200,000 pataka maximum. This is much heavier than the case in PRC and Hong Kong. Next page, please. So this is the fine I just described just now. Okay, next page, please. As for the preparation threshold for the TP documentation, since the new registration does not provide much detail, we can take a look at the situation in Hong Kong and PRC and see how this generally works. In the PRC, taxpayers are required to prepare TP documentation that is local file since 2008. The PRC Tax Authority issued the Brief 14.2 to further request for master file preparation, as well as special documentation to cover the cost sharing, thing capitalization. In practice, many local tax authorities in the PRC would request the taxpayer to meet the documentation preparation threshold to submit the master file and local file. And some tax bureau will score this documentation. They may even request the taxpayer to redo the documentation if the scoring is lower than certain level. The PRC documentation is quite similar to the OECD requirements, but there are some local requirements, such as value chain analysis, cost saving, and market premium factor analysis, etc. In recent years, the tax authority also issued an internal guideline which require further details or analysis of the local file and master file. In terms of the penalty, non-compliance is generally subject to a fine around 10,000 renminbi to 20,000 renminbi. However, the underlying risk will be potential transfer pricing investigation and the additional 5% penalty interest rate during the investigation. As for Hong Kong, the IRD introduced the TP regulation as well as the three-tier documentation requirement in 2018. In this table, I have summarized the TP documentation preparation threshold in PRC and Hong Kong. In terms of threshold, any PRC enterprise that meets one of the related party criteria during the fiscal year will need to prepare local file. However, enterprise only carry out the domestic transaction with no tax difference are not required to be covered. For instance, if one party is a high-tech enterprise with a 15% tax rate and the other one is a general enterprise with a 25% tax rate, even if both enterprises are in the PRC, they will still need to prepare a local file. Further, we should also take note that the local file is mandatory if the PRC enterprise is with a simple function and risk profile but running losses. For Hong Kong documentation requirement, the thresholds of master file and local file are similar to those in PRC. As you may also notice from the table that the Hong Kong threshold are largely similar to the PRC, but they are only have factored in some foreign exchange adjustment. Hence, the transaction involving financial assets include interest as well as the loan principal amount for the year, which is slightly different from the PRC threshold, where in PRC, the interest is usually seen as other related party transaction, and loan drawdown does not come into the threshold. Moreover, any transaction that can satisfy the specific domestic transaction condition, including domestic nature and no actual tax difference, will not come into the above threshold. Furthermore, the Hong Kong IRD also set out some exemption conditions to lessen the compliance burden of some small enterprise. For instance, a company can be exempted from preparing master file and local file, even if it has a huge related party, if it satisfies 2 or 3 following criteria. The total revenue is no more than 400 million Hong Kong dollar. Total assets no more than 300 Hong Kong dollar, or the employee of no more than 100. For Macau, the preparation threshold are yet to release. However, if we look at the APA application threshold, which we will introduce in a later part, is the only amount confirmed in the new registration. It's basically the same as the PRC APA application threshold. So personally, I think it's very likely that Macau's threshold will be similar to those in PRC or Hong Kong. Next page, please. TP adjustment is adjustment to the transaction of the past year. Is there any way that completely avoid the TP adjustment? Yes, that is the APA. Next page, please. APA Advanced Pricing Agreement is a proactive approach used by the taxpayer and the tax authority to establish the transfer pricing methodology for future transactions between the related parties. Before comparing the APA regulation in the PRC, Hong Kong, and Macau, so let me first briefly introduce the APA. There are unilateral APA, bilateral APA, and multilateral APA. UAPA means that only one tax bureau is involved, and bilateral APA, BAPA would include the tax bureau of the counterpart, the country where the counterparty is located. That means both two tax bureaus are involved. Similar to the MAP, typically the bilateral APA and multilateral APA are likely to require the DTA is necessary between the respective country or the regions. For example, Macau company purchased the goods from the PRC, and if the Macau taxpayer and the PRC taxpayer both submit the application to their tax bureau, this will become a BAPA. The tax bureau of the both sides would negotiate based on the application and the evaluation of the applicants. The advantage of APA includes increased certainty of the TP arrangement, better pricing planning. Generally speaking, tax bureau will not investigate the APA transaction. Taxpayer apply for APA usually will have a better reputation and connection with the tax authority. The AP application is introduced for the first time in the new registration, including implication threshold requirement, whether it can be rolled back, etc. Next page, please. A Macau taxpayer and its related party can apply for APA if the related party transaction exceed 40 million pataka in a year. The applicant need to submit the necessary information to the FSB. Proposed financial year, detail of the related party and the transaction, intended transfer pricing method, and other important information. Next page, please. The Financial Service Bureau, FSB, has the right to accept or reject the taxpayer's application. If the taxpayer and the FSB successfully reach an agreement, the taxpayer would require to submit an annual report within 7 months after the end of each implementation year, instead of a local file. In the PRC and Hong Kong, the annual report will be much simpler, shorter than the local file. It only needs to report the applicant's business situation and the implication result of the year to the Tax Bureau. So no benchmarking or no industry analysis are needed. That is why quite simpler and shorter. This is why also mainland and PRC and Hong Kong do not need to cover APA transaction while preparing the local file. Next page, please. We have summarized some key factors in the PRC and Hong Kong, and also as well as Macau. The first APA in PRC are in the 1990s. And the first BAPA was with Japan. Still in charging this case, and is the fifth time for the renewal. As of the end of 2023, the number of the APA signed in China continued to increase, including 155 UAPA and 143 BAPA. Among them, 35 BAPA are completed in 2023. Hong Kong only had one BAPA in 2023. And so far, there's less than maybe 10 cases. Regarding the application threshold, the Mainland Tax Bureau requires the amount of the related party transaction in the past 3 years with an annual amount no less than 40 million renminbi, while Hong Kong has different amount requirement according to the transaction type. The amount of Macau is also 40 million pataka, which is similar as that's it in PRC. The application period is no more than 5 years. Next page, please. Generally speaking, it takes time to reach an agreement with the Tax Bureau. So the taxpayer usually choose a longer period, say 5 years. Although the APA is for future years, the same transaction also occur in the past year. Taxpayer can also require to roll back. The PRC Tax Bureau can roll back to up to past 10 years, while in Hong Kong, reserve this declaration to the IRD. The Macau regulation mentioned that it can roll back up to 2 years. The PRC Tax Bureau will not charge any fee to handle AP application, but in Hong Kong and Macau, the Tax Bureau will. The standard has not yet clarified in Macau, while the maximum in Hong Kong is 500,000 Hong Kong dollar. Next page, please. Although Macau has not yet announced the application step, let's take a look at the situation in the PRC and Hong Kong. In PRC, there are 6 stages for all applications. A simplified procedure was announced for the UAPA in 2020. Next page, please. After the first introduction of APA in 2012, Hong Kong revised the guidance for APA in 2020. There were 3 stages, and the steps are quite similar to those in PRC. Generally speaking, a BAPA case will usually take 2 to 4 years for the whole procedure. Next page, please. This is the first time Macau has introduced TP regulation and documentation requirement. This shows that Macau is committed to follow the BEPS framework by implementing the 4 minimal standards under the BEPS initiative. However, as the details of the regulation are yet to release, there's still uncertainty in practical application of the new law. Observations shared in this webinar are therefore for reference only. Going forward, we expect that Macau authority will focus more on the TP topic and will be more strengthened on the Macau taxpayer-related party arrangement. To get ready for such changes, we suggest taxpayers to take opportunity to review your existing related party arrangement that may be subject to new transfer pricing rule and the documentation requirement. And maintain the documentation, for example, transfer pricing policy, internal agreement to defend a group's transfer pricing position. And watch out the issuance of the further guidance. So here is my part for the introduction of the transfer pricing. So I will pass to Guyan to have more the insight of the PE and other topics.
Sure. Thank you, Flora. Next page, please. So the introduction of transfer pricing rule into Macau tax code was a big change to the Macau tax rule. Before that, there wasn't really any formal transfer pricing rules. However, the FSB has from time to time conducted inquiry and audit and adjustment on taxpayers' tax filing. Based on some transfer pricing angle. So it is a big change last year, December, to have a formal set of transfer pricing rules following the OECD model, formally enacted to the Macau Legislative Council. On the same day, December last year, other part of new tax rule have also been enacted into the Macau tax code. The main elements are tax residency concept, the introduction of tax agency appointment, territorial basis, and also permanent establishment concept, PE. So we will look at each of these new tax concept in the next part. Next page, please. So starting on the top, in the new Macau tax code, formally, tax residency concept has been introduced and enacted into the tax code. As Flora has briefly mentioned, Macau currently has limited number of double taxation agreements signed. So for all the other cross-border business activity, in the absence of definition of tax residency, there had been some tax controversy situation caused. So to cater for that, a tax residency concept for both individual and legal entity have been introduced, and it has already been taken effective since 1st January 2025. So for individual, Macau tax resident would mean individual who stays in Macau for more than 183 days, continuously or intermittently during any tax year, or those who stayed in Macau for less than 183 days, but have a domicile in Macau on or before the end of the year, 31st of December of the tax year, and meet the criteria from which it can be referred that the place of domicile is where the individual intends to maintain and occupy as his or her habitual residence. So two rules: either you stay in Macau for the needed number of days, or otherwise there is a place in Macau that can be believed to be referred as the individual's habitual residence. And on the other hand, for legal entity, one would be regarded as a Macau tax resident if it has its domicile or effective management and control in Macau. So this tax residency concept definition has already been, in fact, starting 1st of January this year, and even for cases, without a CTTA with Macau, we can refer to such definition. So turning to the left side and on the bottom, the other three concepts have been enacted into the Macau Tax Code December last year and has been scheduled to take effect from 1st January 2026 onwards. So one major change is individual taxpayer and entity taxpayer that meet the following requirement will be required to appoint tax agent in Macau. Tax agent would be Macau tax resident who practice in his or her individual name. So for individual taxpayer that reside outside of Macau, or they are residing in Macau but would be absent from Macau for more than 183 days in each fiscal year, they would be required to appoint a Macau tax agent for all the ongoing communication with Macau Tax Authority. And for legal entities that have ceased their operation in Macau or that is still in operation, however, do not have a domicile, effective management, or PE in Macau, but at the same time is still deriving income there. Such type of legal entities also are required to appoint a tax agent in Macau to take care of all the ongoing communication with Macau Tax Authority from 1st January 2026 onwards. So turning to the bottom side, as Flora has briefly mentioned, before there is no PE definition in the Macau Tax Code, and one could only refer to the definition based on the few number of double tax agreement that Macau has signed. In the new legislative enactment, also permanent establishment PE definition have been enacted into the new tax code, and also it will take effect from 1st January 2026 onwards. In the later page, we will go through what are the PE definition included in the new Macau tax code. Lastly, on the right-hand side, the Macau tax code has confirmed that Macau complementary tax will adopt territorial basis, and also under certain situation, double taxation relief would be available. So it has confirmed that Macau will adopt territorial basis in the Macau tax code. However, further details or guidance on how to determine the source rule for different types of income, different types of profit have yet to be announced by the Macau Tax Authority or FSB. So the general expectation is Macau may make reference to the neighboring jurisdiction, such as Hong Kong, who also adopts territorial basis principle on the rule for determining the source of each types of income. However, formal guidance and interpretation issued by the government authority is still pending. So for active income, such as trading income, service income, we would need to wait for further guidance from Macau Tax Authority. On the other hand, cross-border passive income in the types of dividend, interest, royalty, and equity capital gain are the top focus of OECD in a view to avoid the situation of double non-taxation. So in the current update of Macau Tax Code, it has also been mentioned that there will be special rules introduced for cross-border foreign source passive income. So for MNC group that operates in both Macau and another tax jurisdiction outside of Macau, if there are any foreign source passive income in the 4 types that I have mentioned, instead of requiring local substance, such income, although they are foreign source, would be deemed to be onshore and taxable, subject to tax under the Macau complementary tax regime. So unlike some of you may have followed in Hong Kong starting 2023 onwards. Similarly, for in cater for the situation of double non-taxation, FSIE regime has been introduced, requiring local substance to be maintained in order to enjoy the non-taxation in Hong Kong. However, for Macau, a simple approach would be adopted. So for all foreign source passive income, it would simply do not require any local substance, but deem such income as onshore taxable. At the same time, we have mentioned the number of DTA that Macau has is limited. So in case any double taxation would be suffered on these 4 types of foreign source cross-border passive income, a unilateral tax credit can be made available in Macau to avoid the situation of double taxation. So that would be clear for how the situation would be for both active income and passive income from 2026 onwards. So next page, please. We have the previous page, please. So we have talked about PE, permanent establishment. Under Article 4 of the tax code, a few definition of PE has been introduced into the Macau tax code, mainly fixed place PE, construction PE, and agency PE. I will not go into further details on each of the definition, as each of the definition are actually the same as the OECD model. Next page, please. One thing that we thought worth highlighting is, again, following the OECD model, in the current tax code update, there has been an absence from service PE definition in the tax code. So in a typical UN model, for any services provided in a jurisdiction for a period of more than 83 days or any 6 months in any 12 months period, a service PE may be triggered, but such service PE definition has not been enacted into the Macau tax code. However, notwithstanding this, we think taxpayers should still make attention to Article 8 and Article 9 of Macau Industrial Tax Regulation. Under that, if a taxpayer carry out certain business activity in Macau, including civil engineering work, survey or research-related activity, science and technological services, consultancy and assistance, one must register at the Macau Tax Authority for its business activity. So we wish to highlight, notwithstanding that in the that there is an absence of PE service PE definition, even if the business activity there may not trigger a Macau PE, we still have to consider in parallel the Macau Industrial Tax Code regulation to see what are the activity requiring a Macau tax registration already, notwithstanding whether a PE has been triggered or not. So next page, please. Similar to the OECD model, notwithstanding the introduction of fixed place PE, agency PE, and construction PE, certain types of business activity would be considered as preparatory or auxiliary in nature, and thus would not trigger the existence of a PE in Macau. So here are the six types of preparatory or auxiliary nature, which is also the same as OECD model. Next page, please. So some of our clients have asked, so what would happen if we will have a PE in Macau? Currently, there has been not yet any official announcement on how the Macau PE will be taxed. Interestingly, if we look at the neighboring jurisdiction, including Hong Kong and PRC, currently there are different ways to tax a PE in the two jurisdictions. So commonly in Hong Kong, if a PE is triggered, one should use a transfer pricing method, TP method, to ascertain the profit attributable to the Hong Kong PE and pay tax according to that at the standard tax rate. And on the contrary, in mainland China, if a PE is triggered, very commonly a deemed basis to deem the operational size based on the operational size to deem the profit, taxable profit for paying the PRC CIT or commonly called EIT is the common approach in mainland China. So it is yet to see for Macau which model or would there be another model adopted to see how the Macau PE should be taxed. Next page, please. Yes, so this is all for today. The next slide is just a recap of the topic that we have go through today. Next slide, please. So Flora and I can recap all these topics together with you. So for my part, I have go through the new taxation concept, including tax residency, tax agent, territorial basis, and double taxation relief for cross-border passive income. And also, I have introduced, the types of PE that has been codified into the Macau tax code.
Okay, for TP, the registration provides a definition for the related party and generally consists three types of related party relation. The law also confines the arm's length principle, and the registration also provides 5 common use TP methods, which are basically consistent with the OECD guideline and the PRC and Hong Kong TP rules. It also empowers that Macau FSB to initiate TP adjustment on a non-arm's length transaction, as well as provide the guidance toward the double taxation relief. On the most important topic covered in the registration, it is the TP compliance requirement, including the documentation and related party disclosure in the tax return. Last but not least, the new law also introduced the AP regime, which aims to provide a greater level of certainty of the taxpayer regarding the TP of their related party arrangement. While the details of the registration are yet to release, we encourage the Macau taxpayer to take this opportunity to review their current related party arrangement, transfer pricing policy, supporting documentation in order to fulfill the upcoming TP requirement. Thank you.
Yes, thank you, Flora. And I'm looking at the questions that we have on hand in the Q&A box. I think one of the questions is raised on transfer pricing. Is there any specific quantitative definition in terms of percentage of shareholding and composition of board of directors? I think, Flora, you have covered that in one of the slides, saying it would require a control of one on another or a control under a common control under a third party entity, right?
Yes, but the percentage, for example, how many people is not is subject to the further supplementary definition.
Correct. And other questions ask about the what is the expectation on the timing of further guidance. So in recent weeks, the Macau FSB has conducted a few open door training or seminar for the taxpayer and the general public to go through the Macao tax code and to also gather some questions. In the seminar, the FSB has acknowledged that under certain areas, such as source rule, territorial basis, and also the transfer pricing rule, further guidance will be needed, and they are working on that. However, unfortunately, there is no definite timing committed by the Macao FSB on the release of such written guidance. And lastly, is a question that I received from a lot of taxpayer concerning Macao is the roadmap of Pillar 2. So last year, December, there was a major tax code reform enacted into the Macao Electoral. However, Pillar 2, the globe rule, was not included there. And based on the recent inquiry with Macao FSB, still there is no concrete implementation timeline of Pillar 2 in Macao as yet. So we will keep an eye on that. If we hear any draft rule, draft timeline, we will update you at once. So Flora, I think we have covered all of our content and all the Q&A. Do you have anything else to add?
It's okay.
Okay. Thank you, Flora, and a special thanks to all of you who have joined us and raised questions to us in the Q&A box. We would like to encourage you to fill out the short survey that will pop up on your screen and tell us about what you think about today's program. If you have joined late, please note that this presentation will be archived for future viewing. If you feel that the others would benefit from this webcast, please also share the webcast via the share this icon or have them visit the Dbrief website. We will respond to all the questions submitted during the webcast in a couple of weeks if it has not been covered in the presentation just now. And also, if you can think of any other questions or comments later, please feel free to reach out either Flora or me at our contact detail. We'll be more happy to connect with you separately by phone or by email. So at last, thank you for your participation in Deloitte's Asia Pacific Tax webcast today. Thank you and goodbye.
Thank you.
Bye-bye.